AMC stock is very much today at a make it or break it moment. And I want to be very clear about this. I don't think the trade itself, the actual concept of the MOAS, is at a make it or break it moment. I don't think this, whether it's an up period or down period that we are about to go into, is going to make or break the MOAS. The data is still here. As long as the data supports it, how can you say it's really a change of trend? The data has not changed behind what we're going to talk about in this video. The chart has changed a little bit, and the market dynamics have changed quite a bit in just the last week or two, and especially today. You're getting more comments from JP Morgan about this recession, and JP Morgan just recently, on December 1st, that was last Thursday, cut their S&P 500 earnings forecast for 2023 from $225 of EPS down to $205 of EPS. So they dropped their EPS target by about $20. That was about 9% of a cut for 2023 earnings. And that is really taking a hit to valuations over the last 2 days now, guys. So we're going to talk about AMC. We're going to look at the charts, this whole make it or break it moment, and let's be 100% clear. Like I just said, it's not for the actual trade of the MOAS. I think that is still very much intact, and it's not going to matter what is said in this video in the grand scope of the MOAS, but really from now until Jerome Powell speaks on December 14th, that's the time frame that I am targeting, because that's what people are targeting in the markets right now. They're thinking out to 2023, but first, guys, we got to get through the Fed, and depending on what the Fed does or says, where their summary of economic projections puts us, and we're going to get a new dot plot from the Fed December 14th, well, that is going to categorize the rest of 2023 up until the Fed speaks. It's anyone's game here, and the dynamic that is taking hold is the valuations that really need to come down still from the levels we're at right now. The valuations are still very lofty, so you're seeing a lot of shorts taking on those short positions. And when you look at AMC on the actual chart, AMC is down about 8.5% today. It was down about 8.81% yesterday. So another big down day. I didn't expect this to happen. I didn't expect to see an 8.5% down day, possibly more by the end of the day. Who knows where this thing actually hashes out, but I expected a neutral, slightly negative day or slightly positive day. I didn't expect a huge green day today. I didn't expect a huge red day today, and we are getting that huge red day. And if you take a look at what is actually happening with the 50-day moving average, the 50-day moving average is at $6.79 per share. You're currently trading at $6.82 per share. And I've said for a while now, I got to be bullish above the 50-day moving average. If we break cleanly under the 50-day moving average, I would not be as bullish, right? And what I mean by a clean break, let's be very clear about the definitions of these things as well. I don't mean a close, call it AMC at, $6.77, 2 cents under the 50-day moving average. I wouldn't consider that. If AMC falls 20, 30 cents under the 50-day moving average by the end of the day today, or if AMC tomorrow goes down another 8%, well under the 50-day moving average, that would be a big break of that moving average. That would force me to turn a little bit more bearish and start talking about new lows, and that would be at $5.05 for AMC is the low in 2022. Now, I don't necessarily expect that to happen because people have good, rosy, optimistic outlooks for AMC earnings for next quarter because of all the blockbuster films that are in movies right now. And just looking out to 2023 and 2024, a lot of areas of the economy might not do well, but I think it's pretty clear if AMC has movies that are going to theaters, which they're going to have a lot of those over the next 2 years, the business will do fine, right? The business, there's a lot of demand for people to go out to theaters. Unless we actually do go into a deep recession, I think you'll still see enough demand to support AMC's valuation. So not to say this is right, that the shorts are shorting the markets right now, or that AMC deserves to see its valuation go down even more. But that's what is happening in the markets today. And a lot of this is coming because JP Morgan, Jamie Dimon, he's a CEO for like 20 some years now. So very important figure in the markets. He says inflation eroding consumer wealth may cause recession next year. While consumers and companies are currently in good shape, that may not last much longer, Dimon said Tuesday on CNBC's Squawk Box. Consumers have 1.5 trillion in excess savings from pandemic stimulus programs and are spending 10% more in 2021, he said. Quote, inflation is eroding everything I just said, and that $1.5 trillion will run out sometime mid next year, Dimon said. Quote, may very well derail the economy and cause a mild or hard recession that people worry about. So more of those recession comments, and obviously the some of the biggest banks, when they say things, the markets tend to pay attention. And this is a big reason why markets are selling off too, just in context to, what Jamie Dimon just said. JP Morgan cuts their 2023 S&P 500 earnings by 9%. So they cut their estimates from $225 to $205. So let's do a quick calculation. As you guys know, the markets are broadly based off of a PE ratio kind of valuation metric. And essentially what it is, make math super easy here. If you had a stock that had $1 of EPS earnings, they made $1 per share in actual profits, right? And let's say they had a 10 times PE ratio. Well, they made $1 in profits for the year. So let's call it every quarter they made a quarter of EPS for the whole year. They made $1 of EPS for the entire year. They had a 15 PE ratio. That's going to be a $15 stock, right? Pretty simple there. Now, with the S&P 500, this is what a lot of trading algorithms trade off of. If you have a 225 PE and roughly the same, or PE, $225 of EPS, earnings per share, for the S&P 500 as a whole, if you go ahead and times that by about 17, where the markets are currently where the markets probably should be trading at, you're sitting at 382 on the S&P 500. S&P 500 here today is trading at 394, so it's not far off where the S&P 500 should actually be trading at, right? Now, it's still like 3% higher than where theoretically it should be, but nonetheless, it's more appropriate. Now, and that was the earlier estimate for 2023. Now, if you have 205 for earnings per share on the S&P 500, times that by 17, you're at 348 on the S&P. That would put the S&P back to its 2022 lows. And that's how big of a difference is a 9% earnings cut, basically, for 2023, or at least the expectations are for a 9% cut to S&P 500 earnings, guys. So that is why it is so important. Now, a lot of people don't fully realize that the average P ratio for the S&P 500 has been in between 13 and 15. Sometimes it can get over 20, like what you've seen during COVID, right? After COVID, a lot of spending, low inflation, right? Things were good. The P ratio was over 20. Well, historically 13 to 15. Let's go ahead and just do 15 for you guys. 205 times 15, that would say the markets would be trading at about 307 for the S&P 500 for the SPY index. Guys, let's just go ahead and give you a little bit of an example of what that would be as far as a percentage move down. That would be from our levels down to 307, another 22% drop from here. So there's a lot of different questions about the valuation, and that is what is pushing the markets down. And until we get clarity from the Fed, how long we're going to have rates higher, where Fed members expect, or when I should say Fed members expect to cut rates, that's when the markets might be able to give the markets a little bit higher of a PE ratio. If rates are going to stay at 5%, well, I think that 15, 16 PE is very logical. If rates do go to, say, 3% by the end of the year, which just granted, would not be good for the stock market. If the Fed cut rates by 200 basis points next year, 2%, the markets would freak out, because why the hell are they doing that? But nonetheless, guys, if that were to happen, say you still got 205 for EPS on the S&P 500, you times that, let's give it a rosy optimistic kind of valuation. Let's give it a 19 times PE. You're still at 380 or 389 to 390 on the S&P 500, which is still $4 less than right now. But let's say earnings are still good. Let's say JP Morgan was right with their initial estimate of 225 for EPS next year. We somehow avoid a recession. We get inflation down. The Fed cuts rates because they can, all in 2023, which I highly doubt would happen, and earnings still remain good. Like, this is very unlikely, guys. So don't take this as your base case. Super unlikely. But let's call it 225 for EPS on the S&P 500 next year. Times that by a 19 PE, you're trading at 428 on the S&P 500, which is roughly where we were back in August. So you could see why the markets are falling based off of this. Not really any, big news for the day, but just valuation wise, it's not a good deal to be buying stocks right now. That's why a lot of people are saying 2023 is going to be the year of stock picking, not the index fund investor. And I do believe that is the case as well, guys. Now let's take a look at AMC. As you can see, AMC is now down about 9%, so we're right on the 50-day moving average, so I want to watch this very closely by the end of the day. But nonetheless, guys, the days to cover is sitting at 6.28, cost to borrow is sitting at about 33.5%, 100% share utilization, shares out on loan 166 million. Estimated short interest of free float sitting at about 20.4%, and about $800 million worth of short positions on AMC, and you do have about 104.5 million shares that are sold short. Cost to borrow max at 39%, cost to borrow minimum at 0.82%, and cost to borrow average at 29.01%. Now, before we go ahead and wrap up this video, because that's really all the data you need to know, option activity, if you're curious, 57% positive order value on the day, so hedge funds still are looking pretty bullish on AMC. $3.11 million worth of options placed on AMC for the day, 33 orders that is comprised of. So numbers are looking really good, right? The numbers are still looking good on Ortex, and I do want to stress this, like I said, before we wrap up this video, because this is probably starting to be a pretty long one. We cover quite a bit of information in this video, but I don't want you to forget that AMC doesn't necessarily have to do what the markets do. That if the markets do fall, that still can be a very positive thing for AMC in terms of squeezing out shorts. And this is something I want to highlight in the next video. So even though a lot of this does not sound good, the calculations I just did don't sound too good. It doesn't necessarily have to affect AMC in that same way. It typically has in 2022, but it doesn't need to. Some of the biggest days we've seen in 2022 so far have happened on days where the markets were deep in the red. So do keep all of that in mind, guys. That is pretty much it for this video. Also, keep in mind, we'll talk about this later on as well, but you do have GameStop earnings coming tomorrow in after hours, guys. So that is it. Thank you for watching. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. If you guys want to come trade with me live in real time as well, link down below in the description of this video. Most importantly, enjoy the rest of your day, and I will see you in the next one.